And it's free.
Whoa! Did you say free?
It is. The cost is nothing, but it is a lot of. It's a lot of diligence on the part of the borrower, but the cost is free. We want you to succeed.
That is awesome. And yes, that's what my clients found out, that it's free. And so free help to get you into your, let's say, first home, or suppose you suffered some financial difficulty. A lot of people have had difficulty with medical expenses and whatnot, may have lost their house trying to get back to it. Here's a way to climb back up. Hi, I'm Gary Hughes, otherwise known as Nova Agent, your agent for life, and this is Yogi. He's the hardest working dog in real estate. Today we're here with this episode of Gary Explains Things with Tom Elwood from Day One Lending, and we're going to talk about mortgage lending for a while. So, Tom, would you introduce yourself and give us a little of your background?
My name's Tom Elwood. I've been with Day One for a little while now. I have 10 years in the mortgage business, helped hundreds of customers, and very familiar with how the process works.
And just so that everybody knows, I guess this is one of those full disclosure things, we're both veterans. So I was a submarine sailor and you were a combat engineer. So I hope all of the veterans who are watching can appreciate that. So know that we're looking out for you, and both of us know a lot about the SBA.
Go Army.
Go Navy. So, Tom, one of the questions I should get, and I don't get enough of, is how do I interview a lender? I know a lot of folks will just either be referred to someone, they'll call up and say, what's your interest rate? And then they compare 2 or 3 people based on the interest rate and say, oh, I'm going to get the best deal from this person. Talk to me a little bit about interviewing the lender, and what are some key things that you think a client should know before they choose their lender?
That's a great question. For someone who's looking at lenders, I think the most important thing is they get their questions answered. At the end of the day, the mortgage note is going to belong to the client. It's, are you comfortable with the mortgage product you got? Do you know the products you didn't get because for some reason they didn't fit your needs as well? All mortgages are trade-offs. You're either trading payment for rate, a shorter term with a lower rate, longer term with a higher rate, and you're just making trade-offs. And the question is, do the trade-offs you make the most sense for you? And any lender you're going to work with should be able to explain that to you satisfactorily.
Well, let's talk about some of those trade-offs, because I don't think that's something that we really get into very much. So that trade-offs might be the type of loan you're saying, so a 30-year fixed versus a 15-year fixed versus an adjustable or ARM, adjustable rate mortgage. What are the differences, key differences there, and who might be best suited for each one of those? So
the vanilla mortgage is a 30-year fixed mortgage. What you're getting with a 30-year fixed mortgage is generally speaking, a middle-of-the-road payment. You're getting it spaced over 30 years. The mortgage portion of the payment's never going to change. Obviously, taxes and insurance will probably go up over time. But you have a lot of consistency knowing what that's going to be. You can always prepay a 30-year mortgage if you want to shorten the term, but you're always going to have that same interest rate for the life of the loan. If you're looking at a 15-year fixed, typically you're looking at interest rate about half a point better in rate. You're looking at a higher monthly payment because you have to pay off all the principal in 15 years instead of 30. Once again, you have a fixed payment. You know what it's always going to be. And there's a lot of comfort in that. Finally, you have adjustable rate mortgages, which might be better characterized as being a hybrid adjustable rate mortgage. You end up with a fixed interest rate for the first 5, 7, or 10 years. And then it'll begin to fluctuate annually after that. Those types of mortgages work best, it seems counterintuitive, but I usually recommend them to a young couple getting married who are moving into a 1-bedroom condo who plan to have kids. That 1-bedroom condo gets small really fast. You typically don't need anything over 10 years. I would very much steer people away from adjustable rate mortgages if they're going to convert to a rental property when they're done. Because an investment property has a higher rate because they have higher adjusters. The ARMs tend to make less sense in that range.
And I did or do just have a client who did that. He purchased a studio apartment down at the waterfront and lived there for 2 years, and now is going to take a job in Washington State. This was all part of the big plan. And so he's now renting that condo so that when he comes back, then he'll buy a larger place for himself as he goes. But this starts to get him into the rental property business at an early age. So those are some of the things that a person might want to think about when they're determining what kind of instrument they want to use to borrow.
Absolutely. Long-term plans matter a lot.
But Tom, I just want to double check something, because logic might tell a person, if I'm getting a 15-year mortgage rather than a 30-year mortgage, that I'm going to pay twice as much on the mortgage payment. So if my mortgage for a 30-year mortgage is $2,000 a month, for a 15-year mortgage it would be $4,000, and that's way too much for me, so I don't want to do it. Is that really true?
A better way of looking at it is about 1.5 times.
Okay, so it's not really twice. You can't use that kind of logic.
No.
To get to the answer.
No, and that's on how amortization schedules work. You pay some portion of the principal balance and all of the interest every month. And if you don't have to double the principal payment to keep the same payment, because your interest rate goes down so much. The amount of interest you owe in that mortgage goes down so
because the
rapidly.
principal goes down so much faster.
Correct.
Okay. Let's talk a little bit about fees, because this is something I think it's real important. Someone you call, okay, we can get you with your FICO score, your credit score, we can get you a 30-year loan. You put 3.5 or 5 or 10 or 20% down, and this is the interest rate you're going to get. Is that all there is to it? How do fees and other charges start to come into this?
So when you have a mortgage and you're buying a property, there are fees associated with the lender and the note, and there are fees associated with title work and the transfer of the property. When you're shopping lenders, the only fees that really matter are the lender fees. Everything else is going to be the same regardless of which lender you choose. Now, under the lender side, you have the lender origination charges, which can vary from lender to lender. And in the case of Day One's made the decision to not charge them at all.
So there are no loan origination fees with Day One?
No.
Okay, so that can be a savings for a person right there.
It can be about $1,500.
Okay.
Separate from that is paying discount points or receiving credits. So when someone says, I have an interest rate of, let's say 7%, that may be with no discount points and no credits. That same person may have been able to get 6% that day, but they would have paid 2.5 points to get there.
When you say paid 2.5 points, what does that mean?
So a point is 1% of the interest on that mortgage paid up front.
So if it's a $200,000 mortgage, that would be $2,000.
Correct.
Okay.
It's almost like saying, if you take this rate, there's no charge. If you want a lower rate, you have to pay me. If you're willing to accept a higher rate, I'll pay you, and you can use those funds for closing. And that's a good way to think of it.
Okay. So when someone's talking to or comparing lenders, because this is America, we all love competition, right? I'm going to call at least 2 people and try to see what I can get here. So they're comparing lenders. You need to make sure that you're checking on the fees as well. So things like the loan origination fee. Are there other fees that kind of can come into play, or that are maybe one person might charge and another one wouldn't?
They all fall in the same bucket, but they'll name them different things. Like you may have an origination fee, some might call it a processing underwriting fee. There's a bunch of names for the fees that are the same. Mm-hmm. You can break those down when you get an official loan estimate. In the block A, all of those fees are the lender fees. You compare them from lender to lender to lender on that loan estimate. The loan estimate legally has to be correct. The stuff that comes before loan estimate is not by law required to be correct. They're more flexible.
So what you really want before you pull the trigger and say, I want to use this company for my loan or this person for my loan offers, is you want to get a formal or written loan estimate?
You want a loan estimate and you want them all from the same day.
From the same day even?
Yes.
Excellent to know. Good to know. And because that's how you compare apples to apples.
Yes.
And then you know you've got the good answer. Good. You know, I always think that, I strongly believe that the person who has the most information makes the best decision. So this just reconfirms that. You've got a lot of information from two lenders. Now you can compare apples to apples. And you know which loan is going to be most financially beneficial. Now you might not go with that one just because you like the other guy, or the other person might be your cousin, or something like that.
Yeah, there's a service aspect as well, in addition to just cost.
And so let's talk about that service aspect for a minute. You're a local lender. You live right here in the area. Are you available on the weekends if someone decides they want to write an offer on a Saturday morning? Can the realtor call you and get an updated letter?
Absolutely.
Saturday afternoon?
Absolutely. And I'm not going to say every weekend, every time, but I'm certainly available. I'm always available by text. And the worst answer I can give is when I'll get back to you that day, that evening. Okay. That's the worst it gets.
So it's not an 800 number in Arizona who...
You call Tom Elwood, you get Tom Elwood.
There you go. Okay, very good. This is awesome, Tom. You, Day One, has a program that I've been very interested in called Financial Stability. Can you talk about the FSP program just a little bit?
Sure. The FSP program is a tool that borrowers use to do one of two things. One is it's to boost their credit to a point where they can qualify for a mortgage, period. Another way of utilizing it is for a borrower that, let's say you're sitting at a 710 and you'd like to get to a 740 credit score, they can make suggestions to help you get there. And the difference between a 710 and a 740, even though you're not changing loan programs, can be a reduction in the mortgage insurance premium. And those are definitely worth your time if you can do them.
And I have a client. Actually, I have a couple of clients who are in that program, not at the 700 level, but the work is to get them to the 640 so that they can qualify for an FHA loan. So that was what was exciting to me, taking someone who had no opportunity at home ownership and having their finances examined closely and then given a set of instructions with follow-up and moving them through that process so that now you're at 640, now we can really start to talk about, and you've put some money away. And Day One also works with the Virginia Housing, where there are opportunities for second loans to help cover some of those costs and all of that. So that pulling all of those programs together can give someone who is just out of reach of a home an opportunity to get that first place. I find that very exciting.
And it's free.
Whoa! Did you say free?
It is. The cost is nothing, but it is a lot of it's a lot of diligence on the part of the borrower. But the cost is free. We want you to succeed.
That is awesome. And yes, that's what my clients found out, that it's free. And so free help to get you into your, let's say, first home. Or suppose you suffered some financial difficulty. A lot of people have had difficulty with medical expenses and whatnot, may have lost their house trying to get back to it. Here's a way to climb back up. And so, so that program is good both there at that end and the person who's just so close to getting a better rate. And maybe if they go into the program and wait a couple of months, follow the instructions, that better rate will help them get to a bigger house, or the house that they really dream about that might be just out of reach right now.
Sometimes it's as little as adjusting how much you owe on a one card versus another. Sometimes it's that small an adjustment that you just turn that knob a little bit, and all of a sudden you're saving $25, $30 a month just by making a small change.
I love helping people like that, and that's one of the reasons I use the tagline, Realtor for Life. But not so much that and I do want clients to keep coming back to me, but this is about living the good life. You live the good life when you're in the right place. Thank you very much for being here today, Tom. Yogi's taken a slot on the sofa, but he bids you a great thank you and a farewell.
I really enjoyed this. Thank you.
Thank you very much. We'll talk again soon.
Sounds good.